Allen Reminick here. Today we're going to talk about the next 3 to 6 months in the stock market, and it appears from the research that we've been doing that there is a very good chance that the stock market's going to really decline a lot. Possibly a crash type pattern has emerged, and we're going to give you the evidence so you can decide for yourself. You never know 100% for sure about anything in the market, and so include that in the story here. However, the information that I'm getting is more strong about the sharp decline than we've seen in a number of years. All right. So, for those of you who are watching the markets, you may have noticed that Netflix, the last couple of months, since November, has had a 50% break. It went from roughly 700 to about 350. And on Monday of this week, which was January 24th, there was a crash type day for Netflix. It just really declined. So I looked at that and I thought, well, maybe there's a connection between Netflix and the rest of the S&Ps, the rest of the stock market. And because that can happen. Sometimes individual stocks can kind of lead the rest of the market. So the idea came in, well, let's see. So I looked back at Netflix, 45-day lag, and it turns out there's a fairly good correlation between Netflix being about 45 days ahead of the S&P, and the pattern that it's had for about 2-3 years now isn't all that different than the S&P pattern going forward. On that basis, I went and looked further, okay? Now, for those of you who have taken our course, we have a course on Bitcoin and how to trade Bitcoin with the Ichimoku cloud. We use this cloud situation to evaluate markets, and sometimes we can see the beginnings of a decline phase in any market when it breaks below what they call breaks below the cloud. And if you look at the picture here, you can see the price of Netflix up here as I move forward, and then it just touches the bottom part of the cloud. The cloud is this blue region, and then it breaks under it. And the arrow over here represents kind of the equivalent point that the S&P market and the Dow Jones have kind of gotten to already. They already had that 1 month break, from January 3rd to January 24th. And this week, and now it's the 28th of January, they're kind of like hanging out this week. They were trying to go down, then there was a huge reversal rally where the Dow was down 1,000 points and it wound up, 100 and so points. It was like 1,200 point rally in a couple of hours and everybody got bullish, But the truth of the matter is this kind of behavior often happens when markets are panicky and when markets are preparing for a real big collapse. They start getting incredibly volatile, the volume increases, the intraday action is bizarre. This week the volatility has increased dramatically. If you look at option pricing, prices have increased a huge amount based upon the implied volatility increasing. So there are signs and symptoms of some increasing heating up of the market. All right. So then what I did was we have what's called pattern recognition, which is you take a look at the last year of the stock market. We actually use 234 trading days. And we have a software program, which is a really good one, that allows you to scan the most recent year, and then it goes through about 100, and it goes back to 1901, and looks for the most similar patterns that match the present one. And then at the end of each pattern, it tells you the correlation relationship between any two markets. A correlation of 100% means they're identical. They're doing exactly the same thing day by day. A correlation of 50% means it's kind of, maybe there's some connection, maybe there isn't. But these are all patterns which we've chosen, which are at least 80%. 82% is a couple of them, 87%, 90%, very high correlations. And therefore, the behavior that has been happening for the last year is repeating very closely, including the January break that we just had, matches breaks in the prior markets that we have seen before. Now, if you take a look at the next slide, just to set this thing up, you can see a picture of the S&P 500 market as of, Tuesday of this week, 25th. And you'll also see that the cloud has been this blue cloud region. When it's blue, it generally means the market's in a good phase, it's bullish. And it broke underneath the cloud for the first time where one bar was completely under the cloud. That hasn't happened since 2020, since the crash in 2020, in February, March of 2020. So this is a rare event, and it happened. And that is that stage that Netflix was in right before it had a little rally, and then it had its really, really bad month, which probably isn't even over at this point. Okay? So we're at that stage in this January decline where it looks like there's going to be a bounce, and then it looks like there's going to be another bigger decline, which could be dangerously uncomfortable for people who have a lot of money in the markets. And we're trying to give you an alert that it may not happen, but it's starting to look more and more like it might happen. And if it does happen, it's going to happen starting in the early part of February. And here we are 1 week away. Monday will be January 21st. The following Monday will be February 6th, February 8th. And February 8th could be the high. February 4th could be the high of the next decline phase. Now, the next thing I did was I looked at those patterns which were exceedingly similar and where there was other reasons than just the pattern based on cycles that we look at to think that that particular pattern may actually have some reality to it aside from the fact that it looks the same, that there was a cyclical connection to the present time in 2022. So we have a bunch of those that we looked at, and I'm going to show them one by one to you, and you're going to see what amounts to extremely similar game. Each one of them has over 80% correlation to the present last 12 months, and each one of them has started to decline, and each one of them has a little rally coming up, followed by a really nasty, unfortunate break. Okay, here we go. In this next chart, it is actually the pattern over the last 12 months that has the highest correlation on a daily basis, daily bar chart, to the present. And it's January 27th of 2022 is matching July 6th of 1946. You say, well, 1946, that's so long ago, and markets were different back then, and what does it have to do with this? But the reality is patterns are patterns, and habits are habits, and knee-jerk patterns in the market have been the same for hundreds of years. They seem to do similar things even though there were more people involved, more money involved. The structural forms are similar. Okay, this particular pattern, as you notice, is very, very close. This one doesn't go up because it kind of already had a little up move a few days. Then it goes sideways for 5 or 6 more days, and then it starts its way down. And that decline lasts until June or July, equivalent this year, June or July of 2022. And that's a pretty good bet that something similar to that could happen, because look how similar the prior action is. If you look at the rally here and the rally there and the decline here and the decline there and the rally and decline and rally here and rally, decline and rally there, then the beginning of a down move, we had a nice down move. You can't ask for a much better fit than that. And the reality is, why should it stop? Why is it that all of a sudden something that's been working the same but's been repeating should stop all of a sudden? Okay, it could, and sometimes it does, but would you bet against it continuing? Because if it does continuing, the market's going to go down another 20%. All right, that's chart number 1. Next one. This one was 1983. It was December 20th of 1983 matches with, again, January 27 of this year. And for all those who are in the market, very few of them probably remember that far back, but I was there regarding my age here. 1983 January, it was freezing cold, very much like what we have now in the Midwest. And there was a high in early January. This would match a high in early February in the present time. So it's approximately 38 years and 1 month. And look at what it does at this point. This is where we are in the present market. The correlated same point in the past one would be here. The little red bar is up, it goes up for 5 or 6 trading days, falls, falls, falls. And it fell from ultimately early January to July. So it was about a 6-month break. This is a longer break than the other one that was in 1946. But they start about the same time, and they're both very severe, and they both are very close to happening, because the high that's prior to the huge break, where I have my cursor right now, that's going to be next week, or possibly a little bit later, as late as February 14th. Some of the patterns could come out a little later. But that's really near, okay? So you don't have a whole lot of time here to prepare, but you do have some time. Not only that, the market's likely to go up next week. It started to go up today. Today's the 28th of January, and we expected that. And now, if it does continue up for another 5-6 days, then it would be matching the game that we've seen before, and then it would continue. So let's look at another one, the next chart. Oh. I'm not trying to scare anybody, but you got to believe this. This is it's a very impressive similarity that's coming around the bend here. Take a look at this next chart. That's the 1987 market. The 1987 market, and it's past the high. We've already had the high. This would be the August high, and that would be, I believe, September 22nd, 1987 would match January 27th of 2022. And then you had a little rally until October 1st, which would be approximately 9 calendar days. So 9 calendar days from today would be this February 7th. And February 7th is a weekend, so it could be the high comes out on the 8th. And then we get what amounts to a huge crash that happened. In that market, it happened very, very fast. But note, the market didn't go up for a long time after that. You know, first it had the crash, and then it went sideways until December 9th in here, so that's a couple months. Then it went nowhere for another few months. So you could say that this whole period in here was kind of a down move, even though the lowest price came in October 20th. It matches some of the other patterns, having longer, more extended declines. Some of them have a low in June, and then they go back down again in September, October of 2022. So it could be this whole year has kind of got some nastiness, where the initial nastiness is the worst, and then possibly you have a retest or something similar in September, October of 2022. Let's look at, so the 87 market matches very well, and it's got about an 82% correlation to the present. Let's go to the next one. This one nobody wants to hear about. This was October 4th, 1929. Hello? God, that's a huge, I mean, that was the nastiest of nasties. 50% break in 1 month, roughly. We may not get anything like that size, but time-wise, the probabilities of the high points and the low points coming in 2022 in similar places could happen, and we only may get another 15% or 20% decline from where we are right now. But nevertheless, the timing may be very similar. Again, look where we're at. We've already had the decline phase, the January decline phase, and in that place we had the September-October decline. Then there's a bounce, and that bounce is going to be next week. That's the equivalent of next week. And then guess what? Dum, da-dum, dum. You know, we got a serious decline coming right after that. And again, it stays down. It doesn't, the low came in, you know, here, like in November, but it stayed down ultimately 2 or 3 more months before it kind of had another opportunity. And later in the year, again, it came down, 6-month rally, and then it came down again. So the pattern here is not all that different than the others. And this one is also 82% correlated with the present market in 2022. Let's go to the next pattern. Okay, this one is 1901. Why? Well, there happens to be a 120-year cycle in life, in a lot of things, in nature, and there are patterns that seem to be repeating 120, 240, 360 years ago that we see in history. And you may go to my other channel and you'll see Allen Reminick about the future, the history of the world, as it were, which has very little to do with the stock market. But the patterns that we see in the stock market actually repeated 1901 pretty closely. And so, and what does that do? Well, look where we're at. It has a slightly different setup. This one's only, again, it's 82% correlated over the last 12 months, and it's prepared for a continued decline for 3 or 4 more months, and then it really doesn't go up for another year. It's kind of a sideways to sluggish market after this next break. Again, it's no good. You know, it's not the kind of thing you want to invest in going long. All right, the next pattern, 1983, we already looked at. This is a composite. This one is the sum of the 3 or 4 matches that we've talked about, the 1946, 1983, 1929, 1987, all added together. And the computer does that for us because it's kind of, you know, labor-intense kind of thing to do. But it's there in one snippet. And here you see what it looks like. You have this little bounce in all of them. You have this big break in all of them. And it keeps going down a few months longer, and the average seems to be. Then it doesn't go up for a long time. You know, this is like another year. So basically it's saying 2022, we have a nasty first, second quarter. Maybe the fourth quarter will also be kind of nasty. And it doesn't really go anywhere until 2023 in terms of going up. This is for those investors who have a lot of money in the market, those investors who, you know, could be hurt if this did happen. And it's not outrageously impossible for this to happen, even though it hasn't happened in a long time. And the Dow's been going up since March of 2009. So, and March of 2022 will be 13 years, you know. But 13 years is a Fibonacci number. And for those of you who like there's an Elliott wave thing that Prechter came up with years ago, talking about how looking at years, Fibonacci number of years, like 5 years ago, 8 years ago, 13 years ago, 21 years ago, you know, 34 years ago, 55, 89 years ago. It turns out that the markets tend to do the same things at those points. And 2021 is very likely, from that point of view, a high point. And we're in 2022. Market started to go down. It's down already 10, 12%. Netflix is down 50%. Facebook and some of these other high-flying stocks are down 20%, more than 20%. Apple has been, you know, sticking with the market. It's down 12% or 10%. This is possibly the beginning of something where, you know, we're going into kind of a bear market setup for at least a year and a half, which is the average bear market's 18 months. Okay, so tradesthefuture.com, that's our website, and you'll find additional information there. You'll also find opportunities for you to take various courses that we offer. We also have services that we provide for those who have already taken the courses. And all this stuff is I've been doing this 35 years, and I wanted to start sharing some of the information that I give to the professionals, and I still do. I have large firms that pay me to give them advice, and now I'm starting to give it to, regular people, because why not? Everybody's at home. It's the COVID time. People are trying to make money on the markets from home on their computers. Most of those people are going to get they're going to have a hard time, because it took me 20 years to figure this thing out. You're not going to figure it out in 5 minutes. If you're lucky, you'll find an advisor who you can follow, or you can find somebody to trade it for you. But if you try to do it yourself, you'll need help. And that's why we're here, to help. Okie doke. Thanks a lot.